Testing, testing. Alright, so I am streaming. I just don't know how to see that I'm streaming. Is it not on the dashboard? Latest streams, but give me like, I want like my, you used to give me my, I want to see my live, dude. Damn, dude, I'm bad at this. Okay, I'm just gonna call it episode 2. Save. There's just no way to see it. There's just no way to see it. Testing, 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 testing. There's just no way to see it. Alright, that sounds fine. Okay. Day 2. Got day 2 in here. Making new notes. Since it's a new day. So the topic for today. Also, I just realized that you guys can't see my I have a little my little player here. I gotta learn to stream my desktop eventually. But yeah, I don't know how to do that, dude. I gotta figure that out. I mean, I know how to do it, but like I just I want to make a different desktop. Yeah. So I'll figure that out one day. So we were looking at 401ks, how to evaluate that. I did say I want to look at index funds today. I could do that. Okay, let's try to do that and then like smack down these like 3 tabs. So index funds. Also, I need to. Okay, block. Index fund is a type of mutual fund or exchange traded fund that seeks to, well, give us the, dude, Investopedia is going to be a staple. Like I said this before. Okay, so an index fund is a type of mutual fund. Give me 1 second. So I've heard a lot of good stuff about this. Index funding, like, God, this is so loud. Maybe I like, oh no, I lower, I got it. I'll lower it on my desktop. But okay. I'll lower it on my desktop and then up it for you guys, and then let me just check what this sounds like. Give me a sec. And then up it for you guys, and then let me just check what this sounds like. Give me a sec. And then up it for you guys, and then let me just check what. Okay, so that sounds a little weird. Testing, 1, 2, 3. This sounds like, testing, 1, 2, 3. This sounds like, testing, 1, 2, 3. This sounds like, am I quieter than before? Testing, 1, 2, 3. Check what this sounds. No way to see it. Alright, so I am streaming, I just don't know. No, we're fine, we're good. Okay. So this is something that I've heard. So I'm excited to read about it, dude. So an index fund is a type of mutual fund or exchange traded fund with a portfolio constructed to match or track the components of a financial market index, such as the Standard & Poor's 500 index. Oh, that's what S&P stands for? Okay. An index mutual fund is said to provide broad market exposure, low operating expenses, true, and low portfolio turnover. These funds follow their benchmark index regardless of the state of the markets. Index funds are generally considered ideal core portfolio holdings for retirement accounts, such as individual retirement accounts and 401k accounts. Legendary investor Warren Buffett has recommended index funds as a haven for saving for the later years of life. Rather than picking out individual stocks for investment, he has said it makes more sense for the average investor to buy all of the S&P 500 companies at the low cost that an index fund offers. Okay. An index fund is a portfolio of stocks or bonds designed to mimic the composition and performance of a financial market index. Index funds have lower expenses and fees than actively managed funds. Index funds follow a passive investment strategy. Index funds seek to match the risk and return of the market based on the theory that in the long term the market will outperform any single investment. How index funds work, or index fund works. Indexing is a form of passive fund management instead of a fund portfolio manager actively stock picking and market timing, that is, choosing securities to invest in. So, securities. What are securities in finance? This is interesting. Refers to a, oh my god, dude. Are you serious? The term security refers to a fungible, negotiable Um, fundable, fungible, negotiable financial instrument that holds some type of monetary value. Security can represent ownership in a corporation in the form of stock, a creditor relationship with a governmental body or a corporation represented by owning that entity's bonds or rights to ownership as represented by an option. Okay, this is interesting. So I should also bring up my other one just so I have the. Also, that was gonna be my. I could delete this because it's empty. Because we saw it, it was a presentation. So this is Arial 15. Back to Arial 10. What's the proper way to use parentheses? Oh, we should also get ChatGPT running here. How are we not gonna have ChatGPT? Oops. My birthday was actually, fun fact, I was born in '94. And, you know, June babies were the best, right? So, great. Okay, tomfoolery. Oh, you have to verify phone number. Okay, we'll get it. We'll get it in the next episode. Next stream, we'll get it. We won't worry about the. Socks. Where were we? We were here, right? Whoa. Why do you wait? Hold on, give me a sec. Okay. So I wanted to know what are options. See, this is the thing. This is just wormhole after wormhole. I'm fine with it, but I just like I'm trying to figure out where the best way to navigate this. So what is a call option? Call options are financial contracts that give the option buyer the right, but not the obligation to buy a stock, bond, commodity, or other asset or instrument at a specified price within a specific time period. The stock, bond, or commodity is called the underlying asset. A call buyer profits when the underlying asset increases in price. A call is an option contract giving the owner the right but not the obligation to buy a specified amount of an underlying security at a specified price within a specified. Ah, okay. I got you. So it should be like this. Options, parentheses, call options, and parentheses control should be. Okay. Indexing, okay, so indexing is a form of passive fund management instead of a fund portfolio. Market timings, that is choosing securities to invest in and strategizing when to buy and sell them. The fund manager builds, instead of doing that, they can build a portfolio whose holdings mirror the securities of a particular index. The idea is that by mimicking the profile of the index, the stock market as a whole, or a broad segment of it, the fund will match its performance as well. Okay, yeah, this is good notes right here. Okay, we can close this now, just to not get us confused. Okay. There's an index and an index fund for nearly every financial market in existence. In the United States, the most popular index funds track the S&P 500, but several other indexes are widely used as well, including Wilshire 5000 Total Market Index, largest U.S. equities index. So what are equities? Equity, typically referred to as a shareholder's equity, represents the amount of money that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debt was paid off in the case of liquidation. In the case of acquisition, it is the value of the company's sales minus any liabilities owned by the company not transferred with the sale. In addition, shareholder equity can represent the book value of a company.
Rise like a warrior, a trailblazer, a leader, a mother. Like Allison, Natalie, Alini, like you.
Oh my God, sorry.
Equity has several meanings that vary by their context, but in general, each meaning refers to ownership. Equity is one of the three principal asset classes. The other two are fixed income and cash. Equity also applies to the value of securities in a margin account minus what an investor borrowed from a broker. But in general, equity borrowed from a broker minus what securities in a margin value of securities. Equity also applies to the value of securities in a margin account minus what an investor borrowed from a broker. But in general, equity is the value of a business or property after its debts and liabilities are paid. Think of equity as ownership in any asset after all debts stemming from that asset are paid. A car or a house with no outstanding debt is the owner's equity because she can sell them for cash. Stocks are considered equity as well. Sally's equity can be seen in different examples. She owns 100 shares of stock in ABC Corporation. That stock is her equity in or ownership of ABC. Sally has $75,000 worth of equity in her home. She owes $100,000 on it to the bank, but its current market value is $175,000.
Okay. Okay, so I probably should do this one. This is going to be a lot of definitions, bro. Okay. Right, we read this. The largest equities, U.S. equities index. So if equities represents the shareholder stake in companies, it represents the entire shareholder stakes in a bunch of companies, I guess, right? I guess we could just look it up. Is a broad-based market capitalization weighted index that seeks to capture 100% of the United States investable market. The FT Wilshire 5000 was formerly known as the Wilshire 5000 Total Market Index before being rebranded. Okay, sure. Named for the nearly 5,000 stocks it contained at launch, the Wilshire grew to a high count of over 7,500 in 1998. Since then, the roster has fallen to the current level of 3,687 as of December 31st, 2021. The index includes all U.S. equities with readily available prices, with thinly traded and bulletin board issues excluded. As with all market capitalization weighted indices, the Wilshire overweights companies with a higher firm value and underweights those with a lower firm value. As of December 31st, 2021, the index was 28% towards the information technology sector, 13% towards the healthcare sector, and 13% towards the discretionary sector. I wonder if the technology sector has fallen a bit or gone up. Wilshire, as part of its partnership with the Financial Times, launched 6 other indexes. Okay, sure. The Wilshire 500 index is meant to be the broadest based market index. A broad based index is designed to reflect the movement of an entire market. Although it does not include every publicly traded company, it does include a lot more than the other indices, which people often refer as the market. Like the S&P 500 or the Dow Jones Industrial Average. Ah, okay, so NASDAQ is just 101 securities. Gotcha. Okay. So I assume it's S&P 500, and S&P is actually up today. See, my problem is I used to always look up at NASDAQ, which is like, so I guess this is more consistent, but if I looked up Wilshire 5,000, what did I get? Oh, they don't even give me it. Do they give me the Dow? So they give the Dow 30. What's the Russell? So they do the Russell, which is 2,000. That's cool. What is VIX? What is even VIX, dude? Do you get it just by Googling VIX? You do. So is this not more? Is the ticker symbol and the popular name for the volatility index? Ah, so it's not like the Russell 2000. Russell 2000. Okay, gotcha. But everyone loves the S&P 500. So is it like a? I guess it's like a. Is there a whiteboard on here? Oh, it gives you different workspaces. That's pretty cool. What's that? TikTok. You can. I don't use WhatsApp. I don't use Facebook Messenger. Sorry, I'm just looking at the setups. Oh, they have a crypto wall on here. That's cool. We probably have to look at crypto, but I don't think we're gonna. Sorry, I haven't been playing the music. I don't think we're gonna do crypto because that's a little weird, dude. Like, not weird. It's just it's lame. I mean, look at this. Boom, boom. Kaplat. This is what you've been talking about. I don't like that. I wonder, so like the description of crypto as being very volatile seems to be accurate right now. Could you describe that when the stock market first came to existence? I guess it's too hard. S&P 500 history. So it originated in 83. And like this is just the definitions of returns, right? So right. Okay. Russell 2000, that's cool though. Let's bookmark this actually. Maybe not. Let's not bookmark it yet. Let's understand more. So thank you for that. So that's the Wilshire. There's the MSCI EAF index consisting of foreign stocks from Europe. Bloomberg US Aggregate Bond Index, which follows the total bond market. So I don't know what the bond market is, dude. I have no idea what that means. Like, what are bonds? What are bonds? Bonds are just debt? Are you serious? Wow. I did not see the dude. I do not know these things, man. This is why I started this channel. Fixed income instrument. IOU. Yeah, IOU. Also, we need to know what this fixed income instrument means. Fixed income security is an investment that provides a return through fixed periodic interest payments and eventual return of principal at maturity. Okay. Gotcha, gotcha. Provide investors with a stream of fixed periodic interest payments and the eventual return of principal at maturity. Bonds are the most common type of fixed income security. Different bonds have different terms and credit ratings assigned to them based on the financial viability of the issuer. The U.S. Treasury guarantees government fixed income securities, making these very low risk but relatively low return investments.
For a fixed income security, the periodic return on the investment is the same throughout the life of the security. Principal is returned at the time of maturity. The payment can be in the form of a coupon payment, a dividend on preferred stock, or an interest payment. The rate of return is fixed at the time the security is purchased. Thus, the investor knows exactly how much income he or she will earn from the security. Because of this certainty, fixed income securities usually have a lower rate of return than variable income securities. Fixed income securities are especially popular for risk-averse investors. Examples of fixed income securities are treasury bonds, certificates of deposit, and preferred stock with a stated dividend rate. For instance, an investor might own a 30-year treasury bond with a face amount of $1,000 and an interest rate of 4%. The investor can count on receiving $40 in annual interest payments for 30 years, at which time he or she will receive the final interest payment, plus the return of his $1,000 principal.
Right, righty on. Okay. So that seems pretty... made by a... securitize this.
Rise like a warrior, a trailblazer, a leader, a mother. Like Allison, Natalie, Eleni, like you.
Oh, this is interesting.
Bonds are units of debt issued by companies or governments that are converted into tradable assets. Essentially, bonds are used to borrow money. For example, governments use bonds to borrow money to pay for schools, roads, and other infrastructure. War can also create a sudden need for funds. There are basically four primary categories of bonds sold in the markets: corporate bonds issued by companies, municipal bonds issued by states and municipalities, government bonds issued by the U.S. Treasury, and agency bonds issued by government-affiliated organizations such as Fannie Mae. For investors, bonds are thought of as fixed income instruments because they typically pay a fixed interest rate, or coupon rate, to bondholders, although bonds with variable interest rates are also common. Most bonds share common characteristics. The issue price is the price at which the bond issuer originally sells the bond. The face value is the amount the bond will be worth at maturity. The coupon rate is the percentage of interest the issuer will pay on the bond. The coupon date is the date on which the issuer will make interest payments, and the maturity date is when the bond matures and the issuer pays the bond's face value. The bond market also tends to move inversely with the issuer wins the bond. The rates are also common. Most bonds share common characteristics. The issue price is the price at which the bond issuer originally sells the bond. The face value is the amount the bond will be worth at maturity. The coupon rate is the percentage of interest the issuer will pay on the bond. The coupon date is the date on which the issuer will make interest payments, and the maturity date is when the bond matures and the issuer pays the bond's face value.
Interesting.
The bond market also tends to move inversely with interest rates, so bonds will trade at a discount when interest rates rise and at a higher price when interest rates fall. In short, a bond could be thought of as an IOU between the lender and borrower that includes the details of the loan and its payments.
Okay. So bonds are debt instruments and represent loans made to the issuer. Governments at all levels and corporations commonly use bonds in order to borrow money. And governments need to fund roads, schools, dams, or other infrastructure. The sudden expense of war may also demand a need to raise funds. Similarly, corporations will often borrow to grow their business, to buy property and equipment, to undertake profitable projects for research and development, or to hire employees. The problem that large organizations can run into is that they typically need far more money than the average bank can provide. Bonds provide a solution by allowing many individual investors to assume the role of the lender. Indeed, public debt markets let thousands of investors each lend a portion of capital if needed. Huh, okay. So I'm curious now what this exactly means. Broad-based market capitalization weighted bond market index representing intermediate term investment grade bonds traded in the United States. Investors frequently use the index as a stand-in for measuring the performance of the US bond market. The index tracks government debt, mortgage-backed securities, asset-backed securities to simulate the universe of investable bonds that meet certain criteria. In order to be included in the aggregate, bonds must be of investment grade or higher, have an outstanding par value of at least 100 million, and have at least 1 year until maturity. Interesting. Okay. Wait, NASDAQ is 300? I thought NASDAQ, didn't we just see NASDAQ is 100? Oops. Mm. Do I take these seriously? They're from. I mean, that's just. This is like. I don't know what to say about this. Is it not just better? Is this not just better? Like the only times it's worse are in these beginning years. Interesting though, but that's 0809. This is cutting it off. Okay, interesting. I wish I could ask ChatGPT. We passed it though. An index fund tracking the DJIA, for example, Dow Jones Index Average, Industrial Average, would invest in the same 30 large and publicly owned companies that comprise that index. portfolios of index funds only change substantially when their benchmark index is changed. My benchmark is a standard against which something is compared. Investors use benchmarks to measure the performance of securities. Generally, broad market and market segment stock and bond indexes are used for this purpose. Even cryptocurrencies have benchmarks, hallmarking the importance of having something to compare an asset's performance to. Okay. If the fund is following a weighted index, its managers may periodically rebalance the percentage of different securities to reflect the weight of their presence in the benchmark. Wait, John Bogle? When did he start? Oof. Rest in peace, man. Investor, business magnate, and philanthropist. I don't know what this, oh, he has this. Select low-cost funds. Consider carefully the added costs of advice. Do not overrate past fund performance. Use past performance to determine consistency and risk. Beware of stars. Beware of asset size. Don't own too many funds. Buy your fund portfolio and hold it. Investing in an index fund is a form of passive investing. The opposite strategy is active, as realized in actively managed mutual funds, the ones with the securities picking, market time portfolio the managers described above. One primary advantage that index funds have over their actively managed counterparts is that the lower management expense ratio. A fund's expense ratio, also known as the management expense ratio, includes all of the operating expenses such as the payment to the advisors, managers, transaction fees, taxes, and accounting fees. Because the index fund managers are simply replicating the performance of a benchmark index, they do not need the services of research analysts and others who assist in the stock selection process. Index fund managers trade holdings less often, incurring fewer transaction fees and commissions. In contrast, actively managed funds have larger staffs and conduct more transactions, driving up the cost of doing business. Wow, so that's just like, I need a whiteboard, dude, to like draw this stuff out. Whiteboard online. And you have to sign up for this. And you have to start it. Tutorials point. So if the dude, let's say I have a team that you just offered a sum of money, and with that sum of money they will figure out the best portfolio That looks like a question mark. That's funny. In order to make more money that is greater than this, the money that you initially put in, obviously, right? So then the brokers are probably just asking for a percentage of return instead of it just being a flat. It would be a percentage of this, and then they're earning money off of incredible just portfolios that they themselves could invest in, that again will lead to, this is just like, it just sounds like so much money. I mean, like, someone's paying me to make them more money, but I'm making money off of what they're making, but I'm also get to do the same thing that they're doing for free. Unless, is that banned? Well, no, that's not banned, right? No, it's not banned. So that's insane, man. Because the index fund managers are simply replicating the performance of a benchmark index, they do not need the services of, index fund managers trade holdings less often, incurring fewer transaction fees and commissions. In contrast, actively managed funds have larger staffs and conduct more transactions, driving up the cost of doing business. The extra costs of fund management are reflected in the fund's expense ratio and gets passed on to investors. As a result, cheap index funds often cost less than 0.65%, 0.7%. 0.4 is typical, with some firms offering even lower expense ratios. Expense ratios directly impact the overall performance of the fund. Actively managed funds, with their often higher expense ratio, are automatically in disadvantage. Index funds struggle to keep up with their benchmarks in terms of overall return. So lower risk through diversification, low expense ratios, strong long-term returns, ideal for passive buy and hold investors, lower taxes for investors. It's vulnerable to market swings and crashes, lack of flexibility, no human element, limited gains. So then advocates argue that passive funds have been successful in outperforming most actively managed mutual funds. Indeed, a majority of mutual funds fail to beat their benchmark or broad market indexes. For instance, during the 5-year period ending December 31st, 2022, approximately 80% of large cap U.S. funds generate a return that was less than that of the S&P 500, according to SPIVA from S&P Dow Jones Indices. On the other hand, keep on forgetting to put the music back. Passively managed funds do not attempt to beat the market. Their strategy instead seeks to match the overall risk and return of the market on the theory that the market always wins. Okay. Passive management leads to positive performance, tends to be true over the long term. With shorter time spans, active mutual funds do better. The SPIVA scorecard indicates that in a span of 1 year, only about 51% of large cap mutual funds underperformed the S&P 500. They are better. Okay, so they are better. Also, another category is actively managed money rules. As an example, more than 35% of mid-cap mutual funds. I'm trying to understand, like, the idea. So you want to invest in the long term, but they're making more returns on the short term. So they'd eventually they'd make more money. Like, they would outperform it, right? If you did a large cap mutual fund for a year, I guess what's the idea of changing it is what I'm asking. Because like I'm suggesting the idea of do something for 1 year, do nothing for another year, nothing, updating your mutual fund. But I'm guessing the counter would be that the mutual fund isn't something that is just flexible like that. I don't know. Index funds have been around since the 1970s. The popularity of passive investing, the appeal of low fees, and a long-running bull market have combined to send them soaring in the 2010s. For 2021, according to Morningstar, investors poured more than $400 billion into index funds across all asset classes. For the same period, actively managed fund experienced $188 billion. Right. The one fund that started it all, founded by Vanguard chair John Bogle in 1976, remains one of the best for its overall long-term performance and low cost. The Vanguard 500 index has tracked the S&P 500 faithfully in composition and performance. As of quarter 4 2022, Vanguard's Admiral shares posted an average 10-year accumulation of 260% versus the S&P's 217%, exhibiting a very small tracking error. The expense ratio is 0.04 and its minimum investment is 3,000. What do you mean minimum investment? Like minimum initial investment? Isn't the idea to continuously invest? Index funds may be structured as exchange-traded funds. These products are essentially portfolios of stocks that are managed by a professional financial firm in which each share represents a small ownership stake in the entire portfolio. For index funds, the goal of the financial firm is not to outperform the underlying index, but simply to match its performance. If, for example, a popular stock makes up 1% of the index, then the firm managing the index will seek to mimic the same composition by making 1% of its portfolio consist of that stock. Do index funds have fees? Yes, index funds have fees, but they are generally much lower than those of competing products. Many index funds offers fees of less than 0.4%, whereas active funds often charge fees of more than 0.77%. Have a large effect on investors' return when compounded over long time frames. This is one of the main reasons why popular investment option in recent years are index funds better than stocks. Index funds track portfolio composed of many stocks. As a result, investors benefit from the positive effects of diversification, such as increasing the expected return of the portfolio while minimizing the overall risk. While any individual stock may see its price drop steeply, if it is just a relatively small component of a larger index, it would not be as damaging. Right, and we included that, right? Yeah. Most experts agree that index funds are very good investments for long-term investors. They are low-cost options. They are low-cost options for obtaining a well-diversified portfolio that passively tracks an index. Be sure to compare different index funds or ETFs to be sure you're tracking the best and at the lowest cost. Where to invest that $100,000, or what are you earning? Damn, Masterworks is like. See, so I've seen an ad for this before too, and it was on. It was on like this YouTube channel, so I was like, well, it was a geopolitical YouTube channel, but I was like, okay, it's like, you can't take this seriously, but they've got Investopedia talking about it. They've got, look at all these news publishers. Which makes you really think, is this it? Is this what we need? Should probably. Okay. I didn't take that many notes, but that's interesting. I guess this seems pretty relevant. So a tracker fund. This was the thing we saw yesterday, but that wasn't as relevant yesterday, but now relevant. So let's go. A tracker fund is an index fund that tracks a broad market index or a segment thereof. Tracker funds are also known as index funds, designed to offer investors exposure to an entire index at a low cost. These funds seek to replicate the holdings and performance of designated and constructed. Or, oh wait, I didn't. Did we? We still have one. Put tab. The term tracker fund has evolved. Wait, no, let's read the key takeaways. Tracker funds are pooled investments. So, tracker funds versus index funds. Okay, let me ask ChatGPT in my signed session. Just because I'm a little curious. Okay, so this is pretty much what GBT said. So a tracker fund is a broader term than index fund. Gotcha, okay. So it is a bit broader, we could say, than segment thereof. Tracker funds are pooled investments used to track a broad market. Index fund management is driven by also I need. What is reader mode? Oh, sick, dude. I don't know if you guys like this though, but I feel like this is pretty sick. I gotta figure that out. I mean, I know how to do it, but like, it's pretty sick. I gotta figure. Okay, so but it. Interesting. I'm just gonna get a dark mode. Nice, dude. Awesome, man. We're dark mode now. I'll keep Google Docs. Oh, well, I don't know if I can. So we'll see if it turns darker light. Used to track a broad market. Index fund management is driven by tracking functions, and tracker funds seek to replicate the performance of the market index. How a tracker fund works. The term tracker fund has evolved from the tracking function that drives index fund management. Tracker funds seek to replicate the performance of a market index. Initially, index funds were introduced to provide investors a low-cost investment vehicle that allows for exposure to the many securities included in the market index. The primary advantage of such strategy is the lower expense ratio. Popular indexes for U.S. market exposure include the S&P 500, Dow Jones Industrial Average, and the NASDAQ Composite. Investors often choose traditional tracker funds because the majority of investment fund managers fail to beat broad market indexes on a consistent basis. The majority of tracker funds are either income or accumulation units. Income is paid out to fund holders as cash in the form of the latter, and income is retained within the fund for reinvestment. Right on. So that accumulation unit would be what I want. Tracker fund probably better is like that. As markets have evolved over time, investment companies have sought to meet comprehensive demands by developing new and innovative funds and indexes to satisfy investors. As a result, many investment companies now work with specialized index providers or create their own customized indexes to use in passively managed funds. With this market evolution, tracker funds now encompass a much broader definition. Passively managed tracker funds now include customized indexes for market segments, sectors, and themes. tracker fund strategies have also expanded beyond traditional growth and value index strategies to include indexes screened for a wide range of characteristics and fundamentals. Customized tracker funds still seek to track a predefined market index, but they provide for much more targeted investment, offering relatively low costs for investors. They are able to keep overall fund expenses lower by continuing to use an index replication strategy while getting many of the benefits of active fund management through screened indexes. These funds only need to make significant fund transactions when a customized index reconstitutes, which is typically once a year. I hate this thing. They don't add commas, dude, where they need to be. Customized tracker funds offer investors a broad range of options while also alleviating many of the significant challenges for fund managers in beating the market. What is reconstitution? In finance. Did I really copy reconstitution? Okay. An index fund, a subset of mutual funds or ETFs, has a portfolio that by design tracks the components of an established market index. The Russell indexes are a well-known example of a stock that goes through an annual reconstitution. When considering the Russell index, all publicly traded stocks ranked in order of market capitalization. Gotcha.
Rise like a warrior, a trailblazer,
Oh my god, is it actually mess
a
up?
leader, a mother. Like Allison, Natalie,
Are you
Eleni,
serious?
like you.
Bro, if it doesn't show the video, I'm gonna be mad.
Market capitalization, or market cap, is simply the amount of money that investors have given to a company through the price of their shares. You find out the market cap by taking the number of outstanding shares and multiplying that number by the current price of the stock. So, if there were 1 billion shares of the stock to trade, and it was trading for $10 a share, the market cap of that company would be $10 billion.
Wait, it's shares that aren't owned?
Market capitalization, or market cap, is simply the amount of money that investors have given to a company through the price of their shares. You find out the market cap by taking the number of outstanding shares and multiplying.
What does outstanding mean? Dude, so much stuff. So many terms I don't understand. Shares outstanding refer to a company's stock currently held by all of its shareholders, including share blocks held by. Okay, oopsie. Again. What am I a shareholder if I own a stock? Okay. See, there's a bunch of stuff there that I don't feel like I need to get into yet. Like floating stock, that sounds a little crazy. Why am I still in this mode?
Applying that number.
Then we should also write down this one. Well, I also want to put this in as market cap. Okay. Gotcha. So that they form the basis of the annual reconstitution. New indexes are further shaped by separating out stocks that have become ineligible and adding newly ranked stocks. The Russell indexes are influential enough that other index funds tracked, so the Russell reconstitutions tend to have a direct and immediate impact, changing the constitution of various other index funds, which affects prices and investor holdings. Other indexes tracked by index funds include the Dow Jones, the Standard & Poor's, and the NASDAQ. The reconstitution process for the Russell 2000 works as follows between May and June of a given year. Rank day occurs early in May, which is when a preliminary list of the largest 4,000 publicly traded stocks are ranked and assessed. The end goal is determining which of these will make the reconstituted Russell 3000 index. Later and early, and I wrote down reconstituted, right? Later in early June, FTSE post preliminary. Week later, the process of reconstitution is an efficient way of reflecting changing investor confidence in companies represented on these lists with their public notifications over a series of weeks. Indices give investors and traders a heads up on the companies that will move to and from their respective indices. Since the stocks of the companies affected may see a huge uptick in buying or selling, there's potential for the investor to take quick advantage from these changes and potentially make a quick profit. Yet an investor in index funds must remember that index managers need to buy the additions and sell the exclusions according to this reconstitution and nothing else. They do not make these changes based on performance of the stock, but rather to match the reconstituted. They do not make these changes based on the performance of the stock, but rather to match the reconstituted. Okay. Did I hate myself. Did I put spaces? No, I didn't. I mean, this is getting close to being bigger. The reconstitution effect then means that securities added to the index will typically have a greater purchase demand, raising prices, and for the index's deletions, declining prices. Right, that makes sense. But afterwards, index managers no longer feel these liquidity demands, and so the price effect generally goes into reversal, with an index's additions underperforming and deletions outperforming. This is something I did not know. The more liquid an asset is, the easier and more efficient it is to turn it back to cash. Less liquid, I take more time and have a higher cost. Okay.
Sweat like a trailblazer. A freestyler. A warrior. A mother. Push like a believer. A healer. A leader. A mother. Rise like a risk taker. A rule breaker. A record shaker. A mother. Like Allison, Natalie, Alini. Like you.
An asset's liquidity represents the ease with which that asset can be converted from an investment to cash. Liquid assets are those which are easy to convert to cash quickly and experience little to no change in asset value when converted. Illiquid assets are harder to convert and may have a substantial reduction in value once converted. Cash is the most liquid asset there is, whereas real estate is an example of an illiquid asset because not only can it be difficult to quickly sell a home or other property, there may quick with which that asset can be converted from an investment to cash. Liquid assets are those which are easy to convert to cash quickly and experience little to no change in asset value when converted. Illiquid assets are harder to convert and may have a substantial reduction in value once converted. Cash is the most liquid asset there is, whereas real estate is an example of an illiquid asset because not only can it be difficult to quickly sell a home or other property, there may also be a significant difference between the paper value of the property and the amount it can be sold for. When making an investment, investors will often weigh the anticipated liquidity of an asset along with its potential for gains before making the investment. Liquidity is important to investors for many reasons, including liquid assets give them accessible means to reinvest in other assets when prices are low. Liquid assets reduce some investing risks by ensuring that an investor will be able to quickly react to market moves and lock in and realize investment gains. Liquidity is also important to investors as a means to support their lifestyle needs. A retired individual might like liquid assets because he or she needs to be able to draw an income from their investment portfolio now, not later. A young family with children might like liquid assets because they provide them the freedom to convert assets into cash as needed.
Interesting.
And realize moves and lock in and realize.
So, in other words, liquidity describes the degree to which an asset can be quickly bought or sold in the market at a price reflecting its intrinsic value. Cash is universally considered the most liquid asset because it can most quickly and easily be converted into other assets. Tangible assets such as real estate, fine art, and collectibles are all relatively illiquid. Huh. Interesting. They consider fine art to be illiquid, but Masterworks gets the promotions. Other financial assets ranging from equities to partnership units fall at various places on the liquidity spectrum. For example, if a person wants a $1,000 refrigerator, cash is can most easily be used to obtain it. Cash is the asset that can most easily be used to obtain it. The person has no cash but a rare book collection that has been praised at 1,000. They are unlikely to find someone willing to trade them the refrigerator for the collection. Instead, they will have to sell the collection and use the cash to purchase the refrigerator. That may be fine if the person can wait for months or years to make the purchase, but it could represent a problem if the person only has a few days. They may have to sell the books at a discount instead of waiting for a buyer who is willing to pay for the full value. Rare books are an example of an illiquid asset. Ooh, this is what I was talking about, right? Market liquidity refers to the extent to which a market, such as a country's stock market or city's real estate market, allows assets to be bought and sold at stable, transparent prices. An example above, the market for refrigerators in exchange for books is so illiquid that, for all intents and purposes, it does not exist. The stock market, on the other hand, is characterized by high market liquidity. If an exchange has a high volume of trade that is not dominated by selling, the price that a buyer offers per share and the price that the sellers are willing to expect will be fairly close to each other. This will go in the notes section. Also, we're coming around the time to wrap this up, but let's just close out this liquidity one first. The stock market, on the other hand, is characterized by investors then will not have to give up on unrealized gains for a quick sale. When the spread between the bid and ask price tightens, the market is more liquid. When it grows, the market instead becomes more liquid. Markets for real estate are usually far less liquid than stock markets. The liquidity of markets for other assets such as derivatives, contracts, currencies, commodities often depend on their size and how many. Gotcha. The most liquid stocks tend to be those with a great deal of interest from various market actors and a lot of daily trends. Such stocks will also attract a large number of market makers who maintain a tighter two-sided market. What are market makers? Oh, this looks like a whole other thing. Illiquid stocks have wider bid-ask spreads and less market depth. These names tend to be lesser known, have lower trading volume, and often have lower market. Interesting. Ooh. Gotcha. Interesting. Okay. Well, maybe. Okay. This was a pretty nice day. I thought it was going to be a little slow at first, but this is pretty good. I learned a lot about index funds. So it's let's just go through everything. I guess it would be yes. We should do this every single stream. We should do a review of all the notes that we wrote before we sign off. So, a fixed income instrument is an investment that provides a return through fixed periodic interest payments and the eventual return of principal at maturity. Gotcha. So very stable sort of loans. Securities are fungible, negotiable financial instruments that hold some type of monetary value. Example, stocks, bonds, investment contracts. Options, or rather call options, is an option contract giving the owner the right but not the obligation to buy a specified amount of an underlying security at a specified price within a specified time. So it's an option because I have the option to buy it, right? So equity represents the shareholder's stake in the company, right? Bond, fixed income instrument that represents a loan made by investor to a borrower, typically government or corporate. So it's like the fixed income, but bond mostly huge numbers. Reconstitution, reevaluation of a market index. The process involves sorting, adding, and removing stocks to ensure that the index reflects up-to-date market capitalization and style. Outstanding shares refers to a company's stock currently held by all of its shareholders. Market capitalization refers to the total dollar market value of a company's outstanding shares of stock. Right? Liquidity refers to the efficiency or ease with an asset can be converted into ready cash without affecting its market price. So, indexing is a form of passive fund management. The idea is that by mimicking the profile of the index, the stock market as a whole, or a broad segment of it, the fund will match its performance as well. The strategy index funds instead seek to match the overall risk and return of the market on the theory that the market always wins. A tracker is a broader term than index fund that encompasses various investment vehicles designed to track an index. While index funds are one type of tracker, the term tracker fund can also include other instruments such as exchange traded notes or even separate accounts managed by institutional investors. Tracker index funds. Broader term than it encompasses tracker fund accumulation. We believe would be the best for long-term growth because you're just reinvesting. An investor in index funds must remember that index managers need to buy the additions and sell the exclusions according to this reconstitution, nothing else. They do not make these changes based on the performance of the stock, but rather to match the reconstituted index the fund tracks, right? Right. Market liquidity refers to the extent to which a market, such as a country's stock, allows assets to be bought and sold at stable, transparent prices. Illiquid stocks have wider bid-ask spreads and less market depth. These names tend to be lesser known, have lower trading volume, and often have lower market value and volatility. Thus, the stock for a large multinational bank will tend to be more liquid than that of a small regional bank. But after reconstitution, index managers no longer feel these liquidity demands. Newly added indices getting pumped, deleted indices getting dumped, and so the price effect generally goes into reversal with an index's additions underperforming and deletions outperforming. This can negatively impact performance on all funds tracking these indexes. Interesting. Alright, I feel like that was a pretty successful stream there. Tomorrow I'll just try to be hammering down more of these tabs. We've got a lot of tabs now, so we're going to try to hammer them down and look a little bit more into index funds. Probably next stream will be a lot of understanding the combination of index funds and 401ks, or it could be delving into IRAs. So that will be the next stream, but that was all for today. I will see you either tomorrow or the next day. Definitely the next day, but maybe tomorrow. Goodbye.